Right now, the stock market looks like it's living in its own alternate universe. Every classic warning sign, the same signals that predicted previous market crashes, is glowing red. Household debt is at record highs. Consumers are stretched thin. Economic growth is slowing. Corporate valuations are inflated beyond historical norms. By all traditional logic, the market should have already crashed. And yet, it keeps climbing. So what's really happening? In today's video, I'm going to walk you through the actual forces holding this market up, forces almost nobody talks about, and why the delay in the crash may be the most dangerous part of the entire cycle. My name is Alex. I've spent years working at the intersection of finance, technology, and economic research. And even with a financial background, there was a time I looked at the markets and said, none of this makes sense. Inflation was rising. Recession indicators were flashing. Headlines were bleak. But the stock market? It kept floating upward, as if nothing was wrong. Then I uncovered something important, something that changed the way I see the markets forever. Markets do not crash when things look bad. Markets crash when the invisible support beams finally snap. Once you understand what those beams are, everything happening today becomes predictable. So let's break this down step by step. Why the market looks overdue for a correction. Let's start with the fundamentals. If you only look at traditional indicators, the stock market looks like it should have fallen months, maybe even years ago. The Buffett indicator. Market cap versus GDP. One of Warren Buffett's favorite valuation tools compares the total value of all publicly traded companies to the size of the U.S. economy. Here are the numbers. Total U.S. stock market value. Approximately $66 trillion. Total U.S. gross domestic product. Around $30 trillion. Divide 66 by 30 and you get roughly 220%. Buffett has said multiple times, anything above 100% is overvalued. Anything above 120% is significantly overvalued. Right now, we're at 220%, nearly double the level considered dangerous. To compare, before the dot-com crash in 1999, this ratio was about 115%. Not 150, not 200, 115%. And the market still crashed by more than 60%. So based on this metric alone, the market should be in trouble. But that's not all. Historically, companies in the S&P 500 trade at about 15 to 16 times earnings. Today, the market is trading between 25 and 28 times earnings. But that's not the real issue. The real issue is which companies are inflating the average. Nvidia trades at roughly 53 to 55 times earnings. Amazon trades around 35 to 37. Microsoft trades around 35 to 40. And Tesla trades near 286 times earnings. A price-to-earnings ratio of 286 means investors are paying almost $300 for every $1 of profit. You wouldn't pay $50 for a $1 snack in real life. But in the stock market, people do it without hesitation. And here's the kicker. Right before the dot-com bubble burst, S&P price-to-earnings ratios were between 29 and 32, almost identical to where they are today. So with stretched valuations, high debt levels, slowing economic activity, and weakening consumer balance sheets, the market looks overdue for a correction. And yet, it's still rising. That brings us to the forces propping this market up, the forces most investors can't see. There are two massive, largely invisible forces preventing the market from collapsing. Force 1, quiet. Ongoing government stimulus. A lot of people think stimulus ended when pandemic checks stopped. That is absolutely not true. The government has been stimulating the economy non-stop, just in ways the average person doesn't see, such as expanded credit programs, larger federal budgets, corporate tax incentives, government-funded contracts, emergency lending channels, industry-specific subsidies. Here's the math. The U.S. government collects roughly $5 trillion in taxes every year, but it spends roughly $7 trillion. That extra $2 trillion doesn't come from thin air. It flows into companies, contractors, suppliers, government employees, and eventually consumer spending. Consumer spending accounts for about 70% of the U.S. economy. So even though people are struggling financially, Government spending creates the illusion of economic strength. But there's a problem. The U.S. now has more than $38 trillion in national debt. And just the interest on that debt, the interest alone costs more than $1 trillion every single year. That means the government will eventually have to slow spending. And when it does, the market loses one of its biggest life support machines. But unbelievably, this is not the most significant force at work. The second force is even more powerful. Force $2 devaluation plus persistent inflation. This part is rarely talked about, but it's absolutely crucial. The US dollar is losing strength due to inflation, increasing global trade in non-dollar currencies, geopolitical tensions, falling demand for US treasuries, domestic debt expansion. Countries in the BRICS alliance led by China are actively pushing for international trade that bypasses the dollar. And when global demand for the dollar falls, the dollar becomes weaker. A weaker dollar means imports become more expensive, exports become cheaper, and domestic prices rise. Pair that with ongoing inflation caused partly by the government pumping trillions of dollars into the system, and the dollar loses purchasing power faster. Now here's the twist. When the dollar weakens, companies can report record earnings even if fewer people buy their products. Why? Because prices go up. If a company sells fewer items but raises prices by 10%, revenue still goes up. And Wall Street doesn't care why earnings rise, only that they rise. But here's the part most people never hear. Inflation benefits investors who borrow money to buy assets. Because they repay the loan with weaker dollars, and their assets rise in value as replacement costs increase. This is why hedge funds and institutions have been borrowing aggressively. Inflation rewards them. And since the richest 10% of Americans own nearly 90% of all stocks, they are the ones benefiting from this environment, not everyday workers. All of this sets up the next point. These forces don't stop the crash. They only delay it. Which brings us to the most dangerous question. Why is the crash taking so long to arrive? Here's the truth most people misunderstand. Bad economic conditions do not cause crashes. Crashes are caused by broken confidence. Think of the economy like a suspension bridge. It doesn't collapse when the first crack appears. It collapses when the final bolt snaps. Right now, confidence is hanging by 3 threads. Thread 1. Consumers are still spending money they don't have. The U.S. economy runs on consumer spending, about 70% of total GDP. But consumers are now running near zero savings, relying on credit cards, taking on record levels of personal debt, and facing rising defaults on auto loans and credit cards. This spending won't last forever. Once consumer spending slows, profits fall. And when profits fall, stocks fall. Thread 2. The labor market is weaker than it looks. Unemployment numbers look stable, but they lag behind reality. Here's what's actually happening. Hiring has slowed sharply. Layoffs are increasing. Job openings are shrinking. Wage growth has cooled off. Part-time work is rising. This is the exact pattern seen right before previous recessions. And when people lose jobs or fear losing them, they stop spending. And when they stop spending, corporate earnings crack and markets follow. Thread 3. Rate cuts won't save us this time. Historically, lowering interest rates was the magic solution. Not anymore. Why? Because households are more leveraged, and corporations are carrying more debt. Inflation is still above target, and the cost of basic living has exploded. Lower rates don't help someone whose wallet is already empty. This means the usual safety net may not stop the coming downturn. And this brings us to the most crucial part of the cycle. What always happens right before a major market crash. Every major market collapse follows the same 3-step pattern. We are already inside all 3 steps. Phase 1. The market stays high longer than anyone expects. This is the period where everyone says, "This doesn't make sense. Why is the market still going up?" We are in this phase right now. Phase 2. Investors become desensitized to bad news. This is called crash fatigue. Investors hear inflation, layoffs, debt warnings, earnings misses, geopolitical risk, and eventually they stop caring. This is one of the strongest historical signs that a crash is near. Phase 3. A single event breaks confidence. This is where things snap. The trigger could be a major company missing earnings, a bank failing, a credit event, a liquidity freeze, or even a political shock. The event doesn't need to be dramatic. It just needs to be big enough that investors suddenly say, wait, this is real. Selling accelerates. Liquidity evaporates. The market drops faster than anyone expects. Right now, sentiment surveys like the University of Michigan Consumer Index are already near some of the lowest levels on record. That's not normal. That's a fracture in the bridge. And here's the truth almost nobody wants to admit. The crash isn't canceled. It's delayed. The only reason the market hasn't crashed yet is that temporary forces are holding it up. Government overspending. Inflation boosting fake earnings. Dollar devaluation. Consumers overspending on credit. And big investors using cheap debt to buy assets. But temporary forces don't last forever. When they weaken, and they will, the market will not drift down slowly. It will snap back to reality. The crash isn't avoided. The crash is cued. And the longer it's delayed, the bigger it becomes. This isn't fear-mongering. This is understanding the cycle so you can prepare, stay rational, and make smart decisions. If this gave you clarity, hit the like button, subscribe, and check out the following video on the screen.